In December of the year 2023, Argentina crossed a line few countries survive. In just 30 days, prices rose by more than 25%. Not over a year, not over a quarter. In 1 month, the peso collapsed toward 800 per dollar and money stopped behaving like money. It was no longer something to hold, it was something to escape. Savings lost meaning, contracts were rewritten, daily life turned into a race against tomorrow's price. So how does a country reach a point where its own currency feels unsafe? And when trust in money collapses, is there any real way back? To understand Argentina's crisis, one idea matters more than any policy debate. Argentina does not operate with a single currency. It functions with two. On paper, the peso remains the national currency. Salaries are paid in pesos. Taxes are collected in pesos. Government budgets are written in pesos. Every official transaction still flows through it, but value is measured elsewhere. For years, Argentines have separated earning from preserving. Income arrives in pesos, but security is sought in another unit. Apartments are advertised in dollars. Cars are negotiated in dollars. Construction materials and long-term services are assessed in dollars, even when the final payment is converted back into pesos at the last moment. This pattern did not appear suddenly. It was learned. Repeated inflation, debt defaults, bank freezes, and forced conversions trained households to treat the peso as temporary. Saving in pesos meant exposure to political risk. Holding dollars reduced that exposure. Over time, this response hardened into routine. That routine reshaped daily life. People stopped asking what something costs today. They asked what it would cost after the next adjustment. Multiple exchange rates emerged as a result. An official rate for accounting and trade. Parallel rates that reflected belief. Informal reference rates followed daily as indicators of confidence. These rates did more than signal prices. They shaped expectations. When the parallel rate weakened, prices moved first, not because costs had changed, but because trust had. Inflation in this environment was no longer driven only by money creation. It was driven by anticipation. Businesses priced defensively. Workers negotiated to avoid falling behind. Savers converted early. Each action reinforced the next. The peso circulated quickly, but it was rarely held. This distinction matters. A currency that is used but not trusted cannot anchor expectations. Interest rate signals weaken. Fiscal discipline struggles to change behavior. Central bank promises compete with memory. This is why short-term improvement does not immediately restore confidence. Even when inflation slows, households wait. Firms hedge. Stability is treated as conditional. The peso, in effect, becomes a transaction tool rather than a store of value. It moves through the economy, but it does not settle it. And once trust leaves money, it does not return easily, because at that point, policy no longer interacts with neutral behavior. It collides with habit, a habit formed not by ideology, but by survival. And when reform meets survival instinct, the outcome is shaped less by intention than by reaction. Argentina's crisis did not begin with the latest reforms, but the way the adjustment was delivered reshaped everything that followed. When the new government took office, the economy was already under strain. Inflation was accelerating at a pace that disrupted basic pricing. Confidence in the peso had weakened across households and firms. The gap between official and parallel exchange rates signaled that expectations were already detached from policy. In that environment, gradual reform was judged insufficient. The response was shock. In December of the year 2023, the peso was devalued sharply, aligning the official exchange rate with levels already implied by parallel markets. Energy and transport subsidies were reduced. Public spending fell sharply in real terms. Transfers to provinces were curtailed. Public works were paused. Monetary financing was constrained. The objective was to compress years of adjustment into months and force expectations to change before inflation spiraled further. From a fiscal perspective, the shift was immediate. Real government spending declined. The deficit tightened sharply after years of imbalance. Monetary expansion slowed. Monthly inflation, which had reached extreme levels, began to decelerate in the months that followed. But stabilization on paper did not translate into stability in lived experience. For households, the adjustment arrived faster than incomes could adapt. Utility bills rose while wages lagged behind prices already reset by devaluation. Public sector workers faced layoffs or contract uncertainty during a period of still elevated inflation. Small businesses saw costs normalize upward overnight as demand weakened. Poverty indicators worsened before any benefits of stabilization could be felt. This exposed a structural weakness of shock therapy in Argentina. Shock works best where trust already exists. Argentina entered the adjustment without it. Years of reversals had conditioned society to expect that painful reforms would not last. Previous stabilization efforts ended in renewed inflation or forced conversions. As a result, households learned not to wait for proof. When adjustment arrived, the instinct was not patience. It was protection. Any spare peso was converted quickly. Any long-term commitment was delayed or indexed. Any uncertainty was priced conservatively. External conditions amplified this response. Global financial conditions were tight. Interest rates in advanced economies remained elevated, drawing capital toward safety. Argentina's access to voluntary international markets remained limited by its history of defaults and restructurings. The country attempted one of its harshest adjustments without the cushion of abundant external financing. This mattered because stabilization requires breathing room. Without sufficient foreign currency inflows, every internal gain becomes contested. Dollars used to pay imports cannot rebuild reserves. Dollars saved by households do not circulate domestically. Scarcity turns adjustment into a zero-sum contest between the state, firms, and families. In this setting, the shock did not repair the underlying fracture, it exposed it. Fiscal order improved, inflation slowed, but belief lagged behind data. Because belief is cumulative, and Argentina's memory is long, the adjustment sent two signals at once. To markets, it demonstrated resolve. To society, it confirmed vulnerability. When protection is withdrawn faster than adaptation is possible, credibility competes with fear. This is why the first deep cause of Argentina's crisis is not simply poor policy or bad timing. It is the collision between a rapid adjustment and a society trained by experience to expect reversal. Shock compressed the numbers, but it also compressed tolerance. The chainsaw cut deeply. It did not cut the habit of escape. And once escape becomes the default response, policy loses leverage over behavior. Decisions made at the top begin to collide with instincts formed at the bottom. That collision sets the stage for what comes next. Because when trust is already gone, people do not wait for outcomes. They reorganize their lives around a different reference point. And in Argentina, that reference point is not the peso. Long before any reform package was announced, Argentines had already adjusted to inflation in a way policy could not fully reach. They changed how they defined value. The peso continued to circulate, but it stopped serving as a reference point for the future. People used it to transact, not to plan. For anything involving time, risk, or commitment, a different unit took over. The dollar became that unit. This shift did not require a legal change. It emerged through repetition. Each episode of inflation reinforced the same conclusion. Prices would adjust faster than wages. Savings held in pesos would lose purchasing power. Promises written in pesos would eventually be revised. Behavior adapted accordingly. Income arrived in pesos. Security was sought elsewhere. Apartments were listed in dollars. Cars were negotiated in dollars. Construction materials and long-term services were assessed in dollars, even when final payment occurred in pesos at the exchange rate of the day. The peso handled movement. The dollar handled meaning. This created a parallel system of trust. It was not hidden and not illegal. It was practical. In an environment where inflation persisted year after year, holding pesos became exposure rather than neutrality. Dollars offer distance from domestic political risk. What began as a defensive choice gradually hardened into routine. Once this routine spread, it reshaped the economy itself. Businesses no longer priced goods based only on current costs. They priced against expected depreciation. A weaker peso tomorrow justified higher prices today. Workers negotiated wages to avoid falling behind rather than to move ahead. Savers converted early, accelerating pressure on the currency before policy could respond. Inflation became self-reinforcing, not because money was printed in that moment, but because expectations had already shifted. Parallel exchange rates moved first. Prices followed. The public read this as confirmation. Demand for dollars intensified. This loop operated largely outside official control. Attempts to contain it through currency restrictions produced mixed results. Multiple exchange rates emerged, each carrying a different signal. The official rate reflected policy intent. Parallel rates reflected belief. The gap between them became a daily measure of confidence. When that gap widened, behavior hardened. Even when inflation later slowed, habits did not reverse immediately. People waited. Firms hedged. Stability was treated as provisional. Improvement had to persist far longer than deterioration had taken to appear. This explains why policy success often feels fragile in Argentina. Reform must work continuously to change habits built over decades. One disruption can undo months of discipline. Memory moves faster than credibility. The shadow dollar economy also alters how adjustment is experienced. When prices are liberalized or subsidies reduced, the impact is translated into dollars. What appears as normalization in policy terms feels like loss in lived terms. Households measure change against a stable benchmark, not a volatile one. This creates an imbalance. The state must demonstrate consistency repeatedly. Households need only remember once. As a result, the peso moves quickly through the economy, but rarely settles in it. It passes from paycheck to payment, from obligation to exchange. Money that is not held cannot anchor expectations. This is the deeper damage inflation leaves behind. It changes behavior before it changes statistics. Once trust migrates away from the national currency, every exchange rate movement becomes a psychological event. The economy responds less to policy signals and more to collective memory. And when memory governs behavior, managing inflation becomes less about instruments and more about belief. Which brings the crisis to its most fragile arena, because when households and firms already live in dollars, the exchange rate no longer reflects fundamentals alone. It reflects anticipation, fear, and judgment. That is where the central bank confronts a problem it cannot solve easily. Once an economy begins to organize itself around the dollar, the exchange rate stops behaving like a technical variable. It becomes a signal of confidence. In Argentina, movements in the peso-dollar rate are read instantly and emotionally. A small shift can trigger repricing across sectors. A sharp move can reset expectations overnight. People do not ask whether the rate changed. They ask what it implies about what comes next. This places the central bank in a constrained position. In principle, a central bank anchors prices through interest rates, liquidity control, and communication. In practice, Argentina's central bank operates inside behavior shaped long before each decision is made. Demand for dollars rises not only in response to policy, but in anticipation of reversal. That anticipation creates pressure before fundamentals visibly deteriorate. Multiple exchange rates intensified this dynamic. The official rate communicated policy intent. Parallel rates reflected belief. Informal reference rates changed daily and were followed closely. When these rates diverged, businesses did not wait for convergence. Prices were adjusted defensively, assuming eventual alignment through depreciation. The gap itself became inflationary. When the peso weakened in parallel markets, prices moved quickly. When the central bank intervened to slow depreciation, reserves declined. When reserves declined, confidence weakened further. Each response exposed a new vulnerability. This is the exchange rate trap. Intervene. And scarce reserves are consumed defending a currency few want to hold. Step back, and prices adjust immediately, shifting the cost to households. Neither option restores trust. Recent reforms attempted to narrow this trap by changing the regime rather than the pace. A sharp devaluation aligned the official rate with market reality. A managed crawl sought to guide expectations gradually. Monetary financing was curtailed. These measures improved coherence, but coherence is not belief. For households shaped by repeated reversals, every regime is provisional. Stability must be demonstrated, not announced. Communication competes with memory. Promises are discounted by experience. This explains a critical pattern. Inflation slowed, but confidence lagged. Exchange rate pressure eased, but behavior did not fully adjust because the exchange rate reflects more than trade balances or interest differentials. It reflects perceived durability. When political continuity is uncertain, anchors weaken. When elections can rewrite rules, expectations remain fragile. In systems with strong institutional trust, central banks can influence behavior through credibility alone. In Argentina, credibility must be accumulated slowly. Any interruption resets progress. As a result, the peso continues to circulate without commanding loyalty. It is used to settle obligations, not to preserve value. The exchange rate continues to exist, but it no longer anchors expectations. It transmits anxiety. This gradual erosion has a broader consequence. Monetary sovereignty diminishes without any legal change. When households stop responding to domestic signals and instead anchor decisions to an external currency, policy influence contracts. The central bank becomes reactive rather than directive. It manages volatility rather than outcomes. At that point, frustration grows. If the exchange rate cannot stabilize because the peso is not trusted, then the problem appears structural. If expectations cannot be anchored domestically, then importing an anchor begins to look attractive, not as ideology, as fatigue. When managing a currency becomes a permanent defensive exercise, abandoning the defense can feel like relief. But relief carries a cost, and understanding that cost requires confronting the final cause directly. The promise of imported credibility and the consequences of surrendering control. Dollarization enters the conversation when endurance runs thin. In Argentina, the idea did not grow out of theory. It grew out of exhaustion. After decades of inflation, failed anchors, and abrupt reversals, the currency itself became suspect. When every stabilization attempt ends with another break, the question changes, not how to repair the peso, but whether repairing it is still worth the effort. Dollarization offers a simple promise. It stops inflation driven by domestic money creation. By adopting the United States dollar as legal tender, a country removes its ability to print money. Monetary policy is imported. The price level is tied to an authority outside domestic politics. For societies traumatized by inflation, that promise feels like rescue. The appeal is straightforward. If the central bank cannot be trusted, remove discretion. If the currency cannot hold value, replace it. If expectations cannot be anchored at home, borrow an anchor from abroad. History offers examples. Ecuador adopted full dollarization at the start of the 21st century after a financial collapse. Inflation fell sharply. Day-to-day price volatility receded. Planning became possible again for households that had lost any sense of stability. But stability is not the same as resilience. Dollarization solves inflation by eliminating choice rather than rebuilding trust. Money creation disappears, and with it, the ability to monetize deficits. But so does the capacity to absorb shocks. Interest rates are no longer set domestically. The exchange rate no longer adjusts. The economy loses a buffer. Adjustment does not vanish. It moves. Without a national currency, competitiveness is restored through wages, employment, and fiscal tightening rather than devaluation. When external conditions deteriorate or the dollar strengthens globally, pressure falls directly on incomes and jobs. Pain becomes slower, deeper, and more political. For Argentina, these costs are magnified. The economy is large and diverse. Labor markets are rigid. Politics is fragmented. Dollarization would require converting the monetary base when foreign currency is scarce. Relative prices would be locked under crisis conditions. Future adjustment would depend heavily on exports, capital inflows, and global cycles beyond domestic control. Most importantly, dollarization would not erase Argentina's history. It would preserve its consequences. The same political system that struggled to sustain discipline would operate without monetary escape routes. Every fiscal mistake would be immediately visible. Every shock would transmit directly to employment and income. Social tensions would not disappear. They would concentrate. Supporters argue this is the virtue. Remove discretion and force responsibility. Critics see a different risk, a society stripped of tools but not of conflict. Dollarization changes incentives. Governments lose the option to inflate obligations away, but face stronger pressure to borrow, privatize, or compress spending aggressively. Stability may increase, but flexibility disappears. Reversal becomes extraordinarily costly. This is why dollarization is not a policy adjustment. It is a constitutional shift. Once adopted, it is extremely difficult to undo without triggering chaos. The decision binds future governments as tightly as the present one. Credibility is imported at the price of autonomy, and that trade cannot be renegotiated later. For Argentina, the question is therefore not whether dollarization can stop inflation. It almost certainly can. The question is whether stability purchased through surrender can endure political reality. Whether a society shaped by repeated crisis can sustain a system that allows no monetary margin for error, and whether borrowed credibility is a cure or simply a different form of dependence. Because credibility imported is never free. It arrives with constraints that do not fade with time, and once a country gives up its currency, there is no gradual return. With the causes fully exposed, the focus now widens beyond Argentina itself. The next step is comparison, where different choices produced different costs, and where consequences extended far beyond inflation. Argentina's choices look less abstract when set beside countries that faced similar pressure and selected different exits. None escaped cost. Each traded one vulnerability for another. The most common reference is Ecuador. At the start of the 21st century, Ecuador faced banking collapse, currency failure, and surging inflation. Confidence disappeared quickly. The response was decisive. The country abandoned its national currency and adopted the United States dollar. The immediate effects were clear. Inflation fell sharply. Price volatility eased. Everyday planning became possible again. For households exhausted by instability, this felt like relief. Money stopped changing meaning overnight. The future became predictable enough to navigate, but the long-term consequences revealed a different trade-off. Without a national currency, Ecuador lost its primary shock absorber. When oil prices weakened or the dollar strengthened globally, competitiveness eroded. Adjustment could not occur through exchange rates. It arrived through wages, employment, and migration. Stability replaced chaos, but growth remained constrained. Recovery depended more on external conditions than domestic flexibility. Scale matters here. Argentina is larger, more diverse, and more politically complex. Labor markets are more rigid. Regional differences are sharper. A loss of monetary flexibility would transmit stress unevenly across sectors and provinces. What stabilized a smaller economy could strain a larger one. Another group of countries chose hard anchors without full dollarization. Currency boards and rigid pegs were used to import discipline while retaining a domestic currency. Where institutions were strong, reserves ample, and political consensus durable, these systems held. Where any of those pillars weakened, exits were abrupt and costly. Argentina's history includes such episodes. That memory shapes expectations today. Fixed arrangements are viewed as temporary defenses rather than permanent solutions. Markets test them. Households hedge against them. Stability, when it appears, is treated as conditional. There is a third path, often cited but rarely sustained. Some countries stabilized inflation by rebuilding credibility gradually through fiscal discipline, institutional continuity, and central bank independence. The process was slow, politically painful, and unremarkable. Trust returned not because of a single reform, but because rules stopped changing. This approach demands time, and time is the asset inflation erodes most. The international lesson is blunt. There is no cost-free exit. Dollarization removes inflation risk, but sacrifices flexibility. Hard anchors promise discipline, but invite fragility. Gradual credibility preserves sovereignty, but tests patience. Each choice reshapes social outcomes. In Argentina, the social consequences are already visible. Sharp adjustment stabilizes prices faster than incomes adjust. Fixed income households absorb immediate losses. Informal workers bear volatility directly. Poverty rises before confidence returns. If stability is believed to last, adaptation follows. If reversal is expected, resentment accumulates. Political consequences follow closely. Reforms that deliver macro stability while eroding living standards strain democratic tolerance. Support depends not only on outcomes, but on belief that sacrifice leads somewhere durable. When that belief weakens, electoral cycles threaten reversal. Markets anticipate this risk and price it into exchange rates and capital flows. A feedback loop forms. Political uncertainty weakens confidence. Weakened confidence pressures the currency. Currency pressure lifts inflation expectations. Those expectations undermine reform support. Geopolitical consequences also emerge. Greater reliance on external credibility narrows autonomy. Monetary conditions are shaped abroad. Access to financing becomes more critical. International institutions and global cycles gain influence over domestic outcomes. Sovereignty does not vanish, but it tightens. The broader implication extends beyond Argentina. Once trust in a currency erodes, rebuilding it is harder than abandoning it. But abandonment reshapes the future in ways that cannot be reversed easily. Stability is purchased by giving up discretion. Credibility is gained by accepting constraint. Argentina stands at that intersection. The record offers no miracle, only precedent. Each path demands a choice between speed and endurance, autonomy and assurance. Those choices do not end with inflation. They define growth, inequality, and political resilience long after prices stabilize. And with the consequences visible, the remaining question is not what Argentina wants, but what it can sustain, because the future will be shaped less by the promise of reform than by the commitment that survives when crisis fades and memory remains. Argentina's future no longer depends on discovering a perfect policy. It depends on choosing which imperfection the country can live with. After years of instability, the available paths have narrowed. Each offers relief in one dimension and cost in another. None remove trade-offs. What differs is where the burden falls and whether stability, once achieved, can endure. The first path is gradual credibility rebuilding without abandoning the peso. Under this scenario, fiscal discipline is maintained long enough for behavior to change. Inflation continues to slow. Exchange rate management becomes less reactive. Foreign currency buffers rebuild through trade balances, selective financing, and restored market access. Over time, households cautiously test the peso again, not because trust is complete, but because urgency fades. This path preserves monetary sovereignty and flexibility. It allows policy to respond to future shocks, but it demands continuity. Rules must survive elections. Institutions must resist pressure. One reversal can erase years of progress. Markets understand this risk. Households price it in. Technically sound, this option is politically fragile. The second path is partial anchoring without full surrender. Here, authorities acknowledge reality without abandoning control. Currency competition, stricter pegs, or wider dollar use in savings and contracts aim to anchor expectations while retaining tools. Volatility can fall, exchange rate gaps may narrow, inflation expectations can soften, but credibility remains conditional. Without full commitment, markets test boundaries. Households hedge anyway. Stability holds only as long as confidence does. This path buys time, not certainty. The third path is full dollarization. This is the most decisive and irreversible option. Inflation driven by domestic money creation would end. Monetary credibility would be imported immediately. The exchange rate would disappear as a political variable. For a society exhausted by inflation, that promise is powerful, but the cost is permanent. Argentina would lose monetary policy entirely. Adjustment would occur through wages, employment, and fiscal policy alone. External shocks would hit harder. Recovery would depend more on exports, capital inflows, and global conditions beyond domestic control. Dollarization would lock today's structure into tomorrow's reality. It stabilizes prices by removing choice. Across all scenarios, one constraint dominates outcomes: foreign currency. No stabilization path works without sufficient dollars. Buffers are not just technical reserves, they signal survivability. Without them, every plan is tested immediately. With them, time is gained, and time is the rarest resource in an economy shaped by inflation. This is why discipline alone is insufficient. Discipline creates space, but space must be filled with credibility. Credibility requires repetition. Repetition requires time. Time requires external breathing room. Without that chain, reform cycles repeat. The uncomfortable truth is simple. Argentina cannot stabilize without giving something up. Either patience, flexibility, or sovereignty must be sacrificed. The belief that stability can be achieved without cost is itself a legacy of inflationary politics. What remains is choice, a slow rebuilding of trust that risks reversal, a partial anchor that calms behavior but invites testing, or a full surrender of monetary autonomy in exchange for stability. Each future carries consequences beyond prices. They shape growth, inequality, and political resilience long after inflation fades. And whichever path Argentina chooses, success will depend less on design than on commitment when pressure returns and memory temps retreat. Argentina's crisis is often described as a failure of policy. In reality, it is a failure of trust accumulated over time. For decades, inflation taught Argentines a consistent lesson. Money issued by the state could not be relied upon to preserve value. Each collapse reinforced that belief. Each reform promised change. Each reversal made self-protection more rational than patience. Gradually, survival replaced confidence. The peso remained in circulation, but belief shifted elsewhere. What mattered was not the legality of money, but its reliability. Once that line was crossed, inflation stopped being only an economic problem. It became a behavioral one. Argentina's experience exposes a broader truth. When incentives reward short-term relief over long-term discipline, inflation becomes a political instrument. And when trust is exhausted, technical solutions lose power. No reform works quickly in a society trained to expect reversal. As Charlie Munger warned, "Show me the incentives, and I will show you the outcome." Argentina's outcome was shaped by incentives long before the latest crisis unfolded. The question ahead is not whether inflation can be stopped. It can. The question is whether stability can endure without surrendering the tools that define economic sovereignty. Whether a society shaped by repeated collapse can commit to continuity when memory urges retreat. And whether imported credibility is a foundation or a constraint that reshapes the future. These questions extend beyond Argentina. They matter wherever money is used to postpone reform, and trust is treated as expendable. If this analysis helped clarify how money, power, and behavior intersect, consider subscribing, sharing, and continuing the discussion. Understanding the system is the first defense against repeating its failures.